So it's been a really tough year for investors this year, with a lot of the markets around the world selling off. So today we're going to look at sell-offs and see just how they look historically. And one of the things you'll notice is that there's lots of sell-offs. There's been 13 bear markets, which is where a market sells off 20%, and even more if we get to the 19% decline level. In fact, the average sell-off lasts about 10 months, and the average sell-off falls about 30%. But long-term investors should focus on the upward slope of this chart. Over time, the market usually recovers from sell-offs pretty quickly. But averages aren't all that you want to see. And actually what you look at in this chart is there's been a lot of relatively small corrections, the bluer colors, but they're usually not the sort of corrections that happen in a recession. And so when you look at the sell-offs we see in recessions, which are the yellower colors, some of those sell-offs are much larger. What's important, I think, to highlight is that the sell-off that we've had this year is pretty close to the median sell-off in a recession. So let's look at how this year's sell-off compares to other sell-offs through time. And one of the things you can see is we are definitely one of the larger sell-offs now, the black line that's sort of fallen below a lot of those other lines that are roughly the same in terms of how long they've taken. If we look at the sell-offs that are worse, one of them was COVID, and we obviously all remember COVID, where 50% of businesses were closed down for weeks and a lot of businesses were shut down for months. So that affected corporate earnings and created a huge amount of uncertainty. You've also got the credit crisis, which was a dramatic event in the debt markets that caused some banks to go broke and caused a lot of trickle-down effects in the employment in the industry. You've also got the tech bubble, which obviously had a lot of companies that were earning relatively low actual earnings and potentially negative earnings that also left the market and went broke. The last one that's really worth highlighting is the 74 period, which was an oil price and inflation period, which a lot of people say we're close to right now, because obviously we have the war in Ukraine that's made the price of oil and gas go up, and we also have really high inflation thanks to the COVID stimulus and the impact of that war in Ukraine causing prices to go up in a lot of commodities because of how many commodities come out of the Russia and Ukraine region. The one thing that's different about 74 is we had much higher GDP, we had a much younger economy, and we had much higher interest rates at the start, and actually much higher interest rates at the end of that decade too, which affects valuations too. But at the end of the day, we're talking about buying stocks, and buying stocks really buying the future earnings of all the companies in the market. And so what's interesting to look at is the path of earnings. And you definitely see a recession has a much bigger impact on earnings than a sell-off. Sometimes we actually see market sell-offs, but in hindsight, we actually see the companies kept growing earnings. And so earnings are really important to watch from a stock valuation perspective, but that's also why the market right now is very worried about the potential for a recession as the Fed increases interest rates. If we do cause a recession because of that, companies might see their earnings shrink. They might have some job losses, which makes it even harder for companies to keep growing revenues. And that's when you often see the deeper recessions and the deeper sell-offs that come through in the stock market. So what does this all mean for us trading day to day? What this chart here shows is volatility. And you think of volatility just as how much stocks move up and down in a single day. And what you typically see is once you hit a recession, you get a jump in volatility. That's because of the huge amount of uncertainty into whether we're going to have a deep recession or not a recession, whether the Fed's going to manage a soft landing or not. All of a sudden, the dynamics and the possible outcomes are so much broader than they were before. But the good thing for us to all remember is volatility spikes, but it does tend to decline back close to normal within a month or two. And so we shouldn't see elevated volatility forever. And we should see the market starting to adjust and account for all of the different outcomes and start to see new news that tells us when we're going to recover and when we're going to come out of the sell-off. So when we talk about sell-offs, there's a lot of different definitions in the market. There's a concept of a correction, which is when the market falls 10% from its previous high down. There's also a concept of a bear market where a market falls 20% from its previous high down. But as you can see in the data, a lot of the time we don't actually hit bear market levels, but we fall 19% or close to it. So there's a lot of different sell-offs that don't necessarily meet the bear market definition, but still make investors pretty nervous.